Welcome back. Beginning of July and the new financial year, and it's been pretty brutal for the last 6 months on the ASX. Funnily enough, less brutal than it has been on the American market, which is down 20% in the first 6 months of the year. Today, we're talking to Dean Fergie from Cyan Investment Management. Dean runs the Cyan C3G Fund, which invests in the smaller cap end of the market. Dean, welcome to Fund Monitors.
Yeah, good morning, Chris.
Good to see you back again. As I said, it's been a pretty brutal first 6 months of the year. How have you seen it?
I would say very much the same. It's been an incredibly difficult market. Granted, we had a very, very good period through COVID, but as someone mentioned a while ago, we're kind of having the pain now that we probably should have had 2 years ago at the very start of COVID, when you had, a lot of uncertainty. The thing is that the market was propped up by government spending and the consumer was propped up by that. And so you had this sort of, I suppose, false economy where it was just everything was getting driven by a lot of free public government money. And that's all subsided now, and with a number of other concerns, which sort of started with the Ukraine-Russian crisis, sort of flowed through to increasing commodity prices, which flowed through to inflation, which flowed through to rising interest rates. It was pretty much the perfect storm, which has really, really been aggressive in the first 6 months of this year. It's been a very difficult time to invest long only, and this particularly the smaller end of the market.
So if you had that situation where the market was being inflated effectively by a whole range of things, surely it was only inevitable that if it didn't pop, there'd certainly be a lot of gas coming out of it.
Yeah, look, I mean, that's right. These things are always really easy to say in hindsight. I think at the time, you would have said maybe on, every month, sort of 18 months, the market's got a little bit hot, and it kept running. And I suppose you had investors saying, why aren't you invested more? Why aren't we, sharing this upside? And so I kind of think I've been around long enough to not get caught up in it, but sometimes you get caught up in the fact that there's extreme valuations everywhere. And so you sort of reflect that in your own portfolio. And yeah, absolutely, in hindsight, I feel like we should have taken more chips off the table at the time, what were inflated valuations, but compared to everything else at the time, they weren't inflated. And so, in hindsight, that's definitely something, I would have done differently, but I probably wouldn't be alone out there in the market as well.
Let's just sort of drill down to the fund. Where did you see the particular issues coming? Where have you seen positive signs as well?
For us, where we've struggled the most has been in the lack of liquidity in the market, that you'll have a small number of sellers having an incrementally large impact on share prices. That tends to create its own snowball effect as such. And I suppose acutely coming into the end of the financial year, so June was particularly aggressive in terms of the sell down. I know the emerging companies index was down something like 18, 19% in 1 month, which is a huge pullback over a fall that had already happened in sort of April and March. So that really, really, really hurt the market. But what we've seen is a kind of a real bounce back in the first week and a half of the new financial year. I think investors are probably refocusing on the valuations. There were a number of stocks that were trading at actually really close to cash value, which logically doesn't make a lot of sense. So there's certainly some green shoots in the market at our end, and I think there's a little bit of rationality coming back into the market where people are seeing some real value and starting to buy in. And I think importantly, when everything's really dire and everyone's really, really negative, that's a good time to be buying into stocks. And when the whole market is extremely positive, that's a good time to be taking a few chips off the table. And I think, crypto is maybe a good example of that as well.
Looking forward a bit, you say that the first part of July has been positive and there's been a bounce back, which probably indicates that the pendulum swung too far during June, whether it's tax loss selling or whatever it may be. But how do you see the market over the next 3 to 6 months and potentially beyond that, where we're in a rising interest rate environment? There's still a lot of concern about inflation. The Ukraine situation is continuing without any real sign of ending in the short to medium term.
Yeah, look, I mean, there's a number of uncertainties. I think inflation is a real one, but particularly commodity prices. I think we've seen some abatement in the oil price recently, and obviously oil and fuel prices flow through the cost of everything we have as consumers. Interestingly, we've spent probably the last 3 weeks out visiting a lot of our companies, and those we haven't been seeing, we've been talking to on the phone, and across the board, they're all saying they're feeling really positive about the market. They're seeing good inbound customer calls. They're seeing good volumes. They're seeing reasonably strong revenue, other than perhaps some of the sort of consumer discretionary businesses, which I still think are a little bit weak, or some of the consumer spending is moving towards lifestyle spend rather than hard goods spends. So when we speak to our customers, they're all, or our investments, they're all actually pretty upbeat, which certainly 3 weeks ago didn't correlate to the share prices. So, for us as fundamental investors, we have to feel reasonably optimistic about the future, because that's what we're hearing from our businesses, and we've known them long enough that they tend to give us pretty straight answers. So that's sort of where we base our confidence on, and I think that's starting to flow through the market a little bit at the moment as well, which is pleasing, or perhaps I'd say relieving, given what we've been through in the last 6 months.
So, Dean, you've always held quite a large proportion, or had the ability to hold a large proportion of your assets in cash. Are you redeploying some of that cash at the current time?
Yeah, look, we are. I guess it's, again, we've had a lot of investments that have fallen pretty substantially in the last few months. So we've certainly stuck with those, and in a couple of cases, we've added a little bit to them. But we're also, the thing is, we're, like a lot of people, we're long-term investors. And so we like to hold stocks over a long period of time. We say that's sort of 3 years plus, if they've got a nice growth trajectory. Now, if those stocks maybe move above intrinsic value of, say, 20% over a period of time, and then they move below intrinsic value by 20% for a period of time, that's a fall of 40 or 50%, which, if you're trying to trade that, one, I think it's difficult to do from a time perspective, and two, it's not efficient from a taxation perspective. So we tend to stick with these investments, and whilst it is uncomfortable, ride through them through periods of volatility. So you look, there's definitely a lot of opportunities out there. We still want to keep a little bit of cash on the balance sheet just for other opportunities, or just, I guess, for a bit of conservatism. But at the moment, I think it's a really, really good time to be looking at some of the smaller stocks out there, because it appears from an intrinsic value to be some really, really great value. If you have some confidence in the economy not sliding further.
Then you've always invested, or had the opportunity to invest, in IPOs or pre-IPOs. That market, I get the impression, has dried up quite considerably at the current time. Does that limit the opportunity?
Look, Chris, you're exactly right. The IPO market was red hot last year, and it has completely stopped this year. We haven't seen one even half reasonable IPO in the industrial space all year. So that's, we're talking 6 or 7 months now. What happens is the pipeline gets sort of blocked up, and then when the market becomes a bit more positive, it just opens up and you get sprayed with opportunities. So it's been incredibly lean this year. I mean, there's been a bit going in resources and a few biotechs, but that's not really our space that we play in. And so, yep, the opportunities recently have been really, really limited, but we would suspect probably in the last quarter of this year that there could be a number of really good opportunities for us, and we'll be looking over those very carefully and finding what we think are the best ones to invest in.
And finally, Dean, obviously some of your positions, your invested companies have been knocked around. Are there any that you've exited because the investment fundamentals have changed?
The only one that we've lightened quite significantly is Maggie Beer Holdings, which is I suppose high-end food / hamper business. You know, a lot of these businesses are struggling with the costs of packaging, of, you know, other goods, of transport and stuff. And I think that's one that's been coming under a bit of pressure. And so we've been happy to lighten. But all the other businesses, you know, the share prices in a number of cases have come off pretty substantially. The fundamentals haven't changed, or indeed they've gotten better. So we're pretty confident. You know, we've invested in a small logistics company called Zoom to You. That I think was off 30 or 40% in June alone. And the only thing they announced was a contract with Bunnings Warehouse, which is 200 major retail stores. So, I mean, that sort of stuff just doesn't make sense. So, you know, we ride through the volatility, have a lot of confidence in what we've invested in, and have confidence that the prices will come back to more sensible levels. And, you know, pleasingly, like I said earlier, that's what we're seeing this month. We're seeing a really substantial bounce back in the fund.
Dean, on that positive note, always good to talk to you. Look forward to seeing you soon, and we'll speak to you next time.
Fantastic. Thanks for having me on again, Chris.